Good morning to all. Yes, today we are discussing about the leading central banks in the world. So far, we have discussed many things about central banking, giving emphasis on the Central Bank of Sri Lanka. When we discuss about the Central Bank of Sri Lanka, we focus on what are the key objectives of the Central Bank of Sri Lanka, what are the functions, and how the structure of its operations. Likewise, we discuss in detail about the Central Bank of Sri Lanka. So now you know, even departmental wise, that you know what the activities carried out by the Central Bank of Sri Lanka. Today, the same way that we are going to discuss about some other central banks around the world, uh, within the limited time given that we cannot discuss about all the leading central banks. So what I did, that I selected some of the key central banks. In this session, we're supposed to discuss about what are their key objectives, and also we have to especially focus on the monetary policy of these central banks, and also the governing structure of this central bank. So basically, I focus on these elements of these central banks. So let's first go and discuss about the US Federal Reserve System. This is so-called Fed Reserve System. Uh, so this Fed is actually the most important central bank for many of the other countries around the world, because we all know what is the level of influence that the US has on the other countries, right? Not only in the political perspectives, but in economic perspectives also, that we know there is a very high influence on many other countries. Or that because of that, any of the activities, economic activities in the US, there is a spillover effects on the other economies as well. The Fed Reserve System is the central bank, so it is the central bank. But here we can see that they use that the Fed Reserve System because there is a system in place, because it is a very huge country with 19 districts. So for each district there is a separate central banks. So these all the central banks, when we take them together, that it says that Federal Reserve System. So yes, I said that it is the one of the most powerful and influential central banks in the world. Here it has mentioned why it is that US dollar used for approximately 90% of all the world currency transactions. So we know that even in Sri Lanka, when we look into the transactions in our foreign exchange transactions, that we can see that the volume of US dollars is the highest. So that we can see, even we are a small open economy, but there are some huge countries as well that they all are involved in transactions in US dollars, so that the volume is really high. So that the Fed Reserve System is the authority that have the power to issue US dollars, as well as to determine the value of that dollar, the value of the US dollars as well. So that's why this is important. So whatever the activities or the policies implemented by the Federal Reserve System, it changed the US dollars value. And also the interest rate is also there, US interest rate. So these are influential, and also has kind of a spillover effects to the other economies around the world. That's how I take this Fed Reserve System to the top of our discussion today. So with the US dollar used for approximately 9% of the world currency transaction, the Fed's activities affect on the valuation of many currencies. So even now today, we when we determine the value of rupees, right? That it is that there is that two type of valuation that we can make: domestic value and the international value. So how much our rupee is valued in international terms, that we always link with the US dollars. Likewise, many of the other countries as well, that we can value our currency against the US dollars. So that's why it is important. It was founded by the Congress in 1913. So the Fed Reserve System established in 1913 by the Congress with the objective of providing the nation with more safer, flexible, and more stable monetary and financial system. Right. So these are the objective of establishing the Federal Reserve System, and it has a very long history now. And within this long period, that they have evolved in operations, and that they have expanded their role in banking activities and the monetary activities. Accordingly, that we can identify three key responsibilities that the Fed Reserve System is having. Three key responsibilities to ensure US economies to operate effectively by performing its three primary functions. That monetary policy is one of the key functions, and next the banking supervision, and the third one is financial services. So inside the financial services, they have given focus to the consumer protection regulation and to the payment system of the country. So I think that, hope that you may remember that what are the responsibilities given to the Central Bank of Sri Lanka. Almost all these areas have been covered by the responsibilities given to the Central Bank of Sri Lanka as well. Now you can see how basically I think at the first session of this lecture series, I mentioned that almost all the central bank around the world, we all have the same kind of objectives. So the responsibilities also more similar accordingly. So yeah, now we are going to discuss about the governance structure of the Federal Reserve System. See that there are different entities that we can see. The Board of Governors, that Board of Governor is the top level of the governance. It is the national component of the Fed. That Board of Governors, it's a board. It consists of 7 governors appointed by the president, right? The president of the country, and confirmed by the Senate. These governors serve for 14 years. That the period of servicing is longer than some other countries, because it needs to ensure stability and continuity over time. So we know that this Board of Governors, they make decisions, and the policies, they make policies. So in order to ensure the consistency in these policies, that's why the service period is for 14 years. It is considered a long period. The chairman, that you better remember the names of that key person in each central banks. Normally when you listen to some of the economic news, that you may have heard these names time to time, right? Whatever the statements that they are giving in the social media or in television news and all that, it is considered as very important kind of statements, right? They are that normally that when they are address the media, that means that they are having some sort of information relating to the financial and economic aspects. So that's why their names are so popular. These people are very popular today. The chairman is he's the current chairman, Mr. Jerome Powell, and vice chairman is Richard Clarida. They are appointed for 4 years term, and maybe that we can see that they are reappointed as well, right? So now we know that board of governors, there are uh, 7 governors, right? 7 governors are there. That 7 people are there in that board. Uh, what are the responsibilities given to the board of governors, right? They are basically guide the monetary policy actions. There is a separate committee to make uh, directions to the monetary policy. They are going that there is a separate board. It is called Federal Open Market Committee that we are going to discuss later. That it is the place where make all the decisions, but that board of governors, they are giving the guidance to that committee as well. So their responsibility is to guide the monetary policy, to analyze domestic and international economic and financial conditions. Why? To lead committees that study. There are some subcommittees as well. So they lead these subcommittees to study current issues such as consumer banking laws and electronic commerce. Now, under one of the responsibility that we saw that it called that financial services that they are giving, that under that we saw that consumer protection was there, and also that payment system was there. So now they have to see what are the current developments and what are the regulatory issues are there with respect to the consumer banking laws and electronic commerce. So these areas now, many of the central banks, that they have to give more focus on these areas. The board of governors also exercise board supervisory controls over the financial services industries. So they have some control over all over the financial service industries, administers certain consumer protection regulation, and oversee the nation's payment system. That what I already discussed with you, that consumer protection regulation has been given very uh, uh, important area. It has given more focus on that, as well as the payment system. The board oversee the activities of reserve banks. We are going to discuss about the reserve banks later. Those reserve banks are actually the central banks in different districts, right? For each district, there is a separate reserve banks are there. So that board of governors, they have to oversee the activities and operation of these reserve banks. And also one of the other responsibility of the board of governor is to approve the members of the board of directors in these reserve banks. And also the board sets reserve requirements. You already know what is the reserve requirement, right? When we discuss about the monetary policy of the Central Bank of Sri Lanka. Here I discuss about what is the reserve requirement, that it is a compulsory or the statutory requirement, right? That reserve requirement. Here also by the board of governors also, that they have to set the reserve requirements for depository institution, that we are going to discuss about the depository institutions when we discuss about the financial sector in United States, that we can see there are different type of entities are there in the system. So the depository institutions are one component there. And also, in addition to set reserve requirement for depository institutions, what the board of governors is doing, they have to approve changes in discount rate. Discount is another monetary policy tool used by the Fed Reserve System to control the inflation. So, and they approve the changes in the discount rates recommended by Reserve Bank. So now we can see here, according to the structure of the Federal Reserve systems, so the Board of Governors at the top, So after that, that reserve banks are there. There are chairmen for each reserve banks, right? So there are 19 reserve banks for different districts, and in the New York Reserve Bank is always in the lead line, considering the volume of assets that they are handling, and also the number of entities in their in the financial system in that districts. So it is always in the lead. So anyway, now in overall, that the board of governors, they set the reserve requirement. It is going to be applied for all reserve banks, and reserve banks wise, that they have to recommend the discount rates for their area, and it should be approved by the board of governors. So that's how it is working. And the board's most important responsibility is to participate in the Federal Open Market Committee. So I said that it is the point where take all the monetary policy decision that determines the direction of monetary policy specifically by directing open market operation. So here already we discussed about some tools under the disposal of the Federal Reserve System to conduct their monetary policy operation. One is the open market operations and reserve requirements, and also the discount rates, right? So let's go and see about the Federal Reserve Banks. Sorry, the network of 12, okay, I'm extremely sorry, there are only 12 districts in the United States. 19 are there in the European Union. There are 19 members in the European Central Bank. Extremely sorry. So in Fed Reserve system, that there are 12 reserve banks. So the 12 districts are there. When you go and check the map of the United States, that you can see there are 12 different regions are there. For each region or the district, there are different separate Federal Reserve Banks are there. So in addition to that, 24 branches are there. So 12 Federal Reserve Banks and 24 branches are there. So for some reserve banks, that they have branches in the district, when that the district is going to be very the what it's called, that in their landscape can be very big, and also that the system, the financial system also may be complex. So in order to serve the requirement of the people, sometimes they need to establish branches under each reserve banks. So altogether, that Fed Reserve system is comprised with 12 Federal Reserve banks and 24 branches. And these all are generally oversight, right? The system, and also that the board of governors, that they are supervising the overall activities of those reserve banks. Okay, so the reserve banks are the operating arms of the central bank. Means that the Fed Reserve is the overall entity. So there are Federal Reserve banks, and these Federal Reserve banks are like operating arms of the Fed. Each Reserve Bank's board of directors oversee the management and activities of the district banks. So that in each Reserve Banks, there is a board of directors. The board of directors are approved by the board of governors. Okay, so now let's see what are the key functions of the Federal Reserve banks. They work as the bankers to banker to banks, right? Or the bankers bank. The same function is doing by the Central Bank of Sri Lanka. I said you right that Central Bank of Sri Lanka is functions as a banker to the banks. So what the Fed Reserve Bank is doing, so they store currency and coins and processing checks and electronic payments and other key functions for the banks. And at the same time that they have to supervise commercial banks in their regions. So the same thing that many of the central banks are doing that. Actually, one of the key responsibility of the central bank to ensure the financial system stability. So that supervision part is really important in that sense as well. At the bank for the US government. So you can see that the one of the function of the Central Bank of Sri Lanka is also that, right? The bank at the government. So here the same type of a function is doing by all the Federal Reserve Bank in United States as well as the banks for the US government. So they have to handle the treasury payments, sell government securities, the same way that the Central Bank of Sri Lanka conduct uh, auctions, right? So the treasury bill auctions and assist with treasury's cash management and investment activities. The same kind of a role that they also play. The conduct research, another function is conduct research on regional, national and international economic issues. The next thing, reserve banks interact directly with the banks in their districts uh, through examination and financial services and bring important religion perspectives that help the entire Federal Reserve System do its job more effectively. So, as already discussed, that they supervise the commercial bank in their area or the regions, and while doing so that if they see some important perspectives at the regional level, that they can bring it up to the board of governors. So because that board of governors, that ultimately they are responsible to approve all the decisions with respect to the monetary sector development or the financial sector development. So all these regional perspectives are really important to consider. That's why then one of the responsibility of that uh, district level Federal Reserve Bank is to do such research and collect data and report. And then we are going to discuss about the member banks, who are the members of the Federal Reserve Banks. So not like the Central Bank of Sri Lanka here, we can see many of the Federal Reserve banks that they have member banks. Many commercial banks, nearly 38% of the commercial bank in the United States are members of the Federal Reserve System. National banks must be members. Definitely the national banks that here that we also have the state banks or the BOC, People's Bank, like they are. In USA also there are some national banks. They must be the members of the reserve banks, right? State chartered banks may join if they meet certain requirement. Now you can see different type of member banks are there. The national banks, they must be members of the reserve banks, and some state chartered banks that if they meet all necessary requirements, right, they can be a member of the reserve bank. So it is not compulsory for them to be a member, but it depends on the level that they can meet the requirement. These member banks are stakeholders of the reserve bank in their districts. So now see that they are that these member banks, that they are the stakeholders of the reserve banks. So what this means that they have to hold 3% of their capital as a stock in their reserve banks. So it is a compulsory requirement for them to hold 3% of their capital out of their total capital, that they have to hold 3% with the reserve banks. So that's how it is happening. So that member banks are there. So, but when we get all the banks, that commercial banks, only 38% of banks are the member banks of the Fed Reserve. So the banks that they are called the other depository institutions, right? In addition to the other the member banks, there are some institutions, right? So the other depository institution, that they provide checkable deposits and other banking services to the people. They also giving banking services to the people. These depository institutions include non-member commercial banks, saving banks, uh, then saving and loan association, credit unions, and different type of financial entities. Although not formally part of the Federal Reserve System, that they are not actually the part of the Fed Reserve System, because they are not hold any it's that their capital or anything with the reserve banks as stakeholders. But these institutions are subject to system regulation, including reserve requirements, and have access to system payment service. They are not no, they are not the stakeholders, but still they are servicing by the reserve banks uh, to regulate their systems. So it means that Fed reserves regulate all these entities. And also there is a reserve requirements, right? The same way that we have here is RR. You may remember the time that we discuss about the monetary policy, we discuss about that reserve requirement as well. So the same way that it is at the time that we discuss about SSR, I mentioned that it is a prudential measure to ensure the stability of the system. Like, so that's why here they are also that the other depository institutions, they also have to keep that reserve with the Fed Reserve banks, and also have access to system payment services, or otherwise that they cannot link with the other banks in transactions. So they also have the access into that uh, payment system, that the payment system is facilitated by the central banks, right? So that we are going to discuss now about the Federal Open Market Committee. Already I mentioned that it is the body where take all monetary policy decisions. So it is the monetary policy making body. The committee is made up of 12 members, the 7 members of the Board of Governors. We already discussed about the Board of Governors, and the president of the Federal Reserve Bank of New York. Why? Why it is special? I said you why the Federal Reserve Bank of New York is important, because they are having the higher volume of assets, right, in the system, and also they have many commercial banks under their purview. So it is special and important and influential than the other Fed Reserve bank in the country. So always that the president of the Reserve Bank of New York is always is a member of the this committee, and 4 other remaining 11 Reserve Bank presidents on the rotating basis. That's how that the 12 members are selected. It is responsible for formulation of policy designed to promote stable prices and economic growth by managing the national's money supply, right? See that the key responsibility is to keep prices stable by while promoting the economic growth. So you have to remember what are the key objectives of each of these central banks, right? The voting members for that, here we saw that there are 12 members there in the Federal Open Market Committee. The voting members of the Board of Governors, the President of the Fed Reserves, and President of 4 other Reserve Banks, okay, who serve on rotating basis. So that these all are going to vote. What there are some decisions that they are making together. At last, that they have to vote, and some alternative decisions also can be discussed and suggested, so that they have to select what is the most or the optimal policy. So in that case, that the voting is there. So these members has to vote. have to vote and select what is the most suitable and accepted by most of the members of the committee. Accordingly, the committee is made up of 12 members. The 7 members of the board of governors already I think I have mentioned it here. So all Reserve Bank presidents participated in this committee, right? But uh, they are not actually the members of the committee, but they are participating in these discussions, but they don't have that voting power at the time till they get their turn to be a member of the board, because it comes on rotating basis. So only that overall 12 members are voting to select the policies, but all other governors of or the presidents of other reserve banks are also participating in this committee. Okay, so the chairman of the board of governor chairs this committee as well, the Jerome Powell. So he's a very powerful man in the system. So he's actually the chairman of this committee as well. He's the chairman of the board of governors. The FOMS typically meets 8 times a year in Washington, D.C., 8 times a year. At each meeting, the committee discussed the outlook for US economy and monetary policy options. So you can see that because the time being that all the reserve banks that they are doing some research, collect some information, so they bring them up to this committee, and at that committee they discuss about the ongoing developments in the country, not only the domestically but some international development as well. So there can be several policy options there. So by voting that they are going to come into a decisions, so and select what are the most appropriate monetary policy measures to be implemented at that time. So they meet 8 times a year. And FOMC is an example of the interdependence built into the Fed's structure. So that's how they make decisions. Actually, US is a very big country, and there are 12 districts. So these all 12 districts are actually the part of the overall economic system or the financial system of the country. So that interdependence is there. So that's why they are together making decisions, and also the overall outcome or the final monetary policy decision, it is actually going to be a very cooperative decision. It combines the expertise of the board of governors and 12 reserve banks. So it is not going to be one person's decisions. Regional inputs from reserve banks, directors, and advisory groups bring the private sector perspectives to the committee and provide grassroots input for monetary policy decisions. So when you are going to make a monetary policy decisions, so it has to be powerful to address all the overall issues in the country. That's why it is important to have the contributions of all regional level experts, right? So then there are some more to learn about this committee, because that the decisions that they are making is so powerful and influential, right? So right, the vice chairman of another thing that you have to remember, that we know that the Federal Open Market Committee is the body making all monetary policy decisions in USA, and the chairman is of this committee is also the chairman of the board of governors, right? That currently is Mr. Jerome Powell. So the vice chairman of the committee is the president of the Federal Reserve Bank of New York, right? So the position currently filled by the John C. Williams. So I request you to remember these names. Sometimes it is important you to remember these names. The Federal Open Market Committee has 8 regularly scheduled meetings each year, but they can meet sometimes other than the scheduled meeting that they have to meet when and where required. That sometimes the special issues arise, at that time they have to make decisions, so sometimes it can happen like that. At the time of COVID pandemic, that they have to wait for another month, right? So they have to take immediate decisions to facilitate the economy, so that in that kind of that scenarios that they have to meet. During the meetings, members discuss development in the local and global financial markets, and they have to have some financial forecast. After much deliberation by all participants, because as I said you, that not only the voting members, but the other president or the governors of the other central banks are also going to be participated in that committees, so that they are making decisions. But again, I have to emphasize one more thing to you. The Fed's Board of Governor is in charge of setting the discount rate and reserve requirements, right? While the FOMC is specifically in charge of taking decisions with respect to the open market operations. So I already mentioned you there are three elements in the monetary policy in United States. One is that discount rate, the other one is the reserve requirement, and the other one is the open market operations. To implement the that this committee is basically, they make decision with respect to the open market operations, right? To implement the policy action, the committee issues a directive to the New York Fed domestic trading desk, that there is a specific uh, element is there, that which is called that domestic trading desk. It is there in New York under the supervision of the New York Fed Reserve Banks. So that guides the implementation of committee's policy through open market operations. So these open market operations are carried out by this place. So here you can see what are the monetary policy tools that they are having. The goal of the monetary policy are to promote maximum employment, stable prices, and moderate long-term interest rate, right? So the ultimate objective of implementing monetary policy is more likely similar to the same objective of the Central Bank of Sri Lanka. But you have to remember that they mention about the maximum employment, that they need to promote the maximum employment as well, right? When you are going to promote growth, it is automatically happens, but here they are giving a special focus to the maximum employment as well. By implementing effective monetary policy, the Fed can maintain stable prices, right? That what the objective of implementing the monetary policy, to maintain the stable prices, thereby supporting conditions for long-term economic growth of maximum. So that long-term economic growth and the maximum employment will happen if there is a stable prices. At the time that we discuss about the monetary policy, that I show you how it is helpful to have a stable prices. When there is a high inflation situation, what will happen to the decisions of the people, especially the consumers' perspective and the investments perspective. That if the money that you have today, it will give the same value in the tomorrow as well. That there is a uh, there is no doubt that you can be ended up with the same uh, thing. But when there is a inflation, that always there is the uncertainty there, whether you are going to lose, you don't know, like that. We discuss about that confidence is always need for the consumers as well as for the investors to make their decisions. That why the stable of prices is important, right? I'm not going to discuss that, because at the time that we discuss about the monetary policy, I mentioned and I described you the links in between these two, right? The maintaining a stable prices, how it is going to be helpful to have achieve the objective of sustainable economic growth of a country, right? So the Fed Reserve's three instruments of monetary policy areas are open market operations, discount rate, and reserve requirements. So now you know that already I mentioned that discount rate and the reserve requirements, those are determined by the board of directors at the top uh, level body, right? Governance body of the Fed Reserve systems. But there is a separate committee, as I described you, that there is a what it is called Federal Open Market Committee, FOMC committee, that they are responsible to take all other monetary policy measures with respect to the open market operations. So what is happening under the open market operation? So I hope that you remember the time that we discussed about the monetary policy tools at the disposal of the Central Bank of Sri Lanka. We discuss about open market operation, but here we can see in this system there are some differences, but basically the with the same purpose that the Fed Reserve banks also implement the open market operations. The Fed uses open market operation as its primary tool to influence the supply of bank reserves, right? It is actually they use as the primary tool, the open market operation. This tool consists of Federal Reserve purchases and sales of financial instruments. Basically, the securities issued by the US Treasury, federal agencies, and government sponsors enterprises, right? So the open market operations are carried out by the domestic trading desk of the Federal Reserve Bank of New York. I said that the specific place is there in New York. It is called the domestic trading desk. So actually these all operations are happening online, not the physically basis, but only the in the point. The point is there in the New York Central Bank under directions from the FOMC. So all the directions have been given by the FOMC. The transactions are undertaken with primary dealers, right? So the primary dealers are there to do this transaction, right? So I'm not going to mention all about the open market operation carried out by the Central Bank of Sri Lanka now, or the other, because it will make you confused. So just focus on this, but you have to compare later what are the similarities and the differences in between the open market operations carried out by the Fed Reserve, the Fed, and the Central Bank of Sri Lanka. The same objective, but the way that it is handling here, the financial instruments are also typically same, but the that here they are dealing with the primary dealers, right? But in our case, that in addition to the primary dealers, commercial banks also are there. So, but the objective is like this is similar to change the level of supply money in the system. When the Fed wants to increase reserves, it buys securities, right, and pays for them by making a deposits to the account maintained at the Fed by the primary dealers banks. So they are dealing with the primary dealers. So the primary dealers that they have their accounts with the Feds. So when they want to increase reserves, that they are going to sell securities, right? So that that reserves are coming in. That means that funds are coming inside the bank. So those are the reserves. So they are not going to be in the system anymore, right? When the Fed wants to reduce reserves, that means that need to increase the supply of money. It sells securities, and yeah. Sorry, the other way around, that they are going, that the Fed wants to increase the reserves, means that they are going to increase supply of money into the system. That's why they are buying securities, means that they have to pay for these securities. So these monies are going to be deposited in the primary dealers bank. So that money is out going out to the system from the Fed. So the money supply is increasing. At the same time, in order to to reduce the reserves, that the Fed is selling securities, right? So that it can debit the accounts of the primary dealers. So the money available in the system is going to be less than. By trading securities, the Fed influences the amount of bank reserves, which affects the federal fund rate. So it is called the federal fund rate, right? Or the overnight lending rate at which banks borrow reserve from each other. So this by trading securities, what the Fed can do, by the same time it can increase and decrease the supply of money or the level of money in the system. It's also can influence the federal fund rate or the overnight lending rate which banks borrow reserves from other. So the same thing, like you remember that, no, at the time that we discussed about the open market operations, so we saw how these open market operation impact on the overnight that coal money market in Sri Lanka. So that the banks, that between the banks there are some transactions are happening, right? So that when at that time we discuss in detail how it is happening. Overnight coal money market rates uh, changing according to the level of supply and demand for the fund. The same way here also, that by doing this open market operation by the Fed, it can influence the federal fund rate as well. Federal fund rate is actually not the discount rate. Okay, remember that you may get confused. That discount rate is the it is actually the interest rate charged by Federal Reserve Bank to depository institution on short-term loans. Remember that it is predetermined rate by the Fed. Okay, normally it is determined by the board of governors of the Fed that I said you. So that it is discount rate. Discount rate is the another tool come under the monetary policy, but here the federal fund rate is different. So it is the rate where that banks are borrow from each other. They can either lend or borrow from the other banks. That rate is called the federal fund rate. The federal fund rate is sensitive. Federal fund rate is sensitive to changes in the demand and supply of reserves in the banking system, as I said. So when the reserve banks going to sell securities, means that they are going to absorb some reserves inside, that they are getting money, so that that supply of money is going to be decreased, right? So that federal fund rates, there is a pressure on the federal fund rates to go up, right? Like that, by doing these operations, open market operations, that the federal fund rate is going to be changed, right? Directly influences other short-term interest. That how then it is going to be transmit into the other type of transaction in the economy. So now this is the open market operation. So one of the monetary policy tool with the objective of maintain the price stability. So how it is going to be impact, right? How it is going to be useful in maintaining the stable prices. That what it is. That what here it has been explained. The federal funds rate is sensitive to changes in the demand for and supply of reserves in the banking system. So by doing open market operations, that Fed, that it can change the level of supply of money. So it is going to be impact on the federal fund rates, and thus in turn directly influence other short-term rates. So that the banks, that the rate, federal fund rate is actually the rate or the cost that banks is having funds, right? So when they are going to lend or borrow from each other, that it is the rate applicable for them. So based on that, the rate, actually it is the cost of the fund for the bankers. So based on that, they determine their lending rates, right? So it is first going to be impact on the short term rates, indirectly influence the long-term interest rate as well. So then the foreign exchange rates and the supply of credit and demand for investment, employment, and economic output. That the chain reaction is there. At the time that we discuss about the monetary policy, the previous lesson that we discuss how it is going to be transmit, right? Remember, hope that you remember, we discuss about different transmission channels. So here the interest rate channel, that how it is going to be impact to the other sectors of the economy. Foreign exchange rate, it is going to be impact on the foreign exchange rate as well. So that interest rate is a very important element, right? Because that based on that, the foreign exchange inflows and outflows are happening, right? The investors who willing to invest their money in a country, that if that our interest rate is high, that they can have more return, so that they willing to come, so that foreign exchange inflow, so that it will give what it will give, that it is going to give more foreign funds in the market, so that supply of fund is high, so that that foreign exchange rate is coming down. Like that, there is a link, right? So when there is a low rates in the market, right, interest rate is low, so what will happen, that the for the investors, that funds available for a lower cost, so they are willing to invest more and more, so that they are going to invest in new projects, that we can create more employment opportunities. At the same time, that with the new projects, that uh, that they can have output at a lower cost, so that producers, that they are also going to be positively influenced, so that there is a positive impact, that economic output is also going to be increased. That's how this chain reaction is happening. That's how that open market operation is uh, helpful to maintain price stability. Through that, the country can ensure the long-term economic growth and maximum employment. That's what's their objective of implementing the monetary policy. That's how it is happening. And other than the open market operation, that discount rate is there as another tool of the monetary policy. I already mentioned you what it is. And the reserve requirement, what is reserve requirement? The portion of deposit that banks must maintain either in their vaults or on deposits at Fed Reserve banks. I think that at the time that we discussed about the monetary policy tool of the Central Bank of Sri Lanka, that we discussed about the statutory reserve requirement. So it is also the same type of a thing, that the portion of the total deposits of the commercial banks, that they have to keep that reserves with the central bank. Here the difference is that even that banks can maintain that the reserves in their vaults, right? But in our case, that the bank is depositing those things or keep those reserves with the Central Bank of Sri Lanka. But here the two options are there, so that by increasing that requirement, that reserve requirement, that the that the Fed can decrease the level of money supply in the country, right? So when they have to keep more reserves inside, means that they are not going to use that money, so that in the system, that level of money supply is going to be decreased. So if there is a inflation, a high inflationary pressure, so that Fed predicts that there can be a high inflation in the future, so that what the Fed is doing to increase the reserve requirement. So the level of money available in the system is low, so the purchasing power is low, so the aggregate demand is going to be low, so the inflation is low. That we discussed earlier, listen, right? So what it is, how it is happening. So now you can easily understand. So that's what we want to discuss about the Fed reserve system. So now we are going to move into the other leading central bank of the world. It is European Central Bank, right? So it is established in 1988, right? Actually, it was established as economic and monetary union. So they wanted to have kind of an entity with the free capital movements within the Europe, a common monetary authority. It is going to be a common monetary authority and a single monetary policy across Euro area countries. That's why they wanted to build it up, right? So the European Central Bank was established in, okay, extremely sorry, that decision has been taken that them to go for a common entity in 1988, but that European Central Bank, it was established in 1999 after introduction of the new common currency, this euro, and its progressive adoption by 19 countries. So when they introduced that common currency, later on that there are 19 countries that they all adopted it as their currency. So it is the common currency. So in that sense that they could establish the European Central Bank as a one unit or the union to work as a common monetary authority and a single monetary to conduct one single monetary policy across the area. It is one of the most critically important central bank in the world. Why? That ECB is supervising over 120 banks, including the central banks. There are 19 central banks are there for each country, and also a set of commercial banks in the member countries. So it is going to be a very huge entity. So in a way that they are going to have the responsibility, the huge responsibilities there. The ECB works with the central banks in the state. So there are central banks in the different central banks are there in different countries. So they work together in formulating monetary policy. So that they are going to have a common monetary policy in that sense, so that they can maintain the stable prices in all the countries, and at the same time they are using the common monetary unit, that euro, so they can keep that the monetary unit is strong by maintaining a one monetary policy. The governing council of the ECB is the group that decided on changes to monetary policy. So there is a governing council. So it is where the all decisions are taking over the monetary policy. The council consists of 6 members of the executive board of ECB, plus the governors of all the national central bank from all the 19 European Union countries. The bank's mandate is to keep prices stable in the euro area. That is their mandate. So that is their key objectives. And they contribute to safety and soundness of the European banking system while ensuring the growth is sustainable. So now you can see from country to country, the set of words sometimes different, but more likely that all the countries that they have the same type of the objectives, with the ultimate objective of ensuring the growth is sustainable. Right here, it touches that the price stability and also the soundness of the European banking system means again the financial system stability, right? Unlike the Fed. So now see what is the main difference in between the Fed that we already discussed about the Fed and the European Central Bank. The European Central Bank, they try their best to maintain the annual growth in consumer prices below 2%. So that it is actually the inflation forecast that they have to have the annual growth in consumer prices. That means that annual growth in the consumer price, it is actually measured by the consumer price index. So that index that we can see the growth of that index, that it should be below 2% as an export dependent economy. They then they are actually export in the union, that we can see many of the countries that they are exporters, right? So export dependent economy. The ECB also have a vested interest in preventing excess strength in its currency, because this poses a risk to its export market. So better we understand this function clearly, because why? That they are export dependent economy. Most of the countries are doing exports, so that the value of exports are really important, right? In case that they are going to have a excess in strength in their currency, what means that if in case that the euro is going to be appreciate continuously, right? That means that against the other the currencies, that the euro is going to be appreciated. So what will happen? That they are exporters, so in the export market or the international market, that they are goods, whatever the goods that they are exports are going to be expensive. So what will happen when the exports goods are going to be expensive in the international market? That they will lose the market. That competitiveness is going to be eroded. Why it's happening? Because that their euro is going to be appreciated, right? Appreciated. So compared to the earlier periods, now the importers, right, the other countries, that they have to pay more, right, in their monetary value, that they have to pay more to buy the goods produced in this area, because now the euro has been appreciated. So that's why the European Central Bank is concerned about this as well. They wanted to prevent excess strength in its currency, or otherwise that they are going to lose the export market, they are going to lose that competitiveness. So in order to compete in the international market, that they have to offer their goods and services at a lower prices. Okay, that it is there. So let's see how about the organization structure of the ECB. There are 4 decision-making bodies there. The first one is the Governing Council. That comprises governors of the National Central Bank of the Euro area member states and 6 members of the executive boards, and meet twice a month at the institution's office in Germany. So that it is the Governing Council. What is the primary function? They are the people who formulate monetary policy for the whole area, right? And then they make decisions on the monetary objectives, so the interest rate and the supply of reserves in the euro system, to ensure performance of the function of the other banks, right? Decisions are taking on monetary policy every 6 weeks. And right after they are taking decisions, that president and the vice presidents, that they have to explain them in detail in a press conference, because it is actually a common entity who makes decisions for the entire area, different countries. So it should be very transparent, right? So that's why they always need to maintain that transparency, or otherwise that the member countries are, that they are willingly be members of this one union, right? So that's why it is very important. And the next level is the executive board, comprises of president, vice president, and 4 other executive members appointed by European Council, and serve for an 8-year non-renewable term. The key role is to implement the monetary policy as defined by the Governing Council and manage the day-to-day operations of the CEB. So the executive board is there to implement the decisions taken by the Governing Council. Governing Council is at the top, that they are making decisions. Executive board is responsible to make sure that the policies are implementing, and also they manage the overall operations of the European Central Bank. And then the General Council, it comprises the president, vice president, and governor of the National Central Bank, so that all the governors in the region, that different countries, they have different central banks, so all the governors are the members of this General Council. As a traditional body, the General Council is tasked with fixing the exchange rate for currencies for countries taking up the euro, so that they are fixing the exchange rate of currencies for countries taking up the euro. The Council also contributes to the preparation of the annual report, setting conditions for employment for the European Central Bank members of the staff, and collecting data. So you can see that level to level, that the governance levels are different, and also the key responsibilities given to those bodies are also different. And it's specifically in the General Council that we can see that they are given responsibilities to take some decisions at the state level, that their country level. Supervisory board comprises the chair, vice chair, 4 ECB representatives, and representatives of national supervisors. The board plans and execute the supervisory function of the ECB. It also proposes draft decisions for the Governing Council. These all entities are supporting the top council to do their job properly. That's why it is important here. Okay, now let's see what are the roles of the ECB. That this is very important. The primary function is to maintain price stability, as we saw, and safeguard the value of euro. So here that you can see that already I mentioned, not like the Fed, that their main responsibility is to maintain the price stability, but here in addition to that, that European central banks, that they have to maintain price stability and safeguard the value of the euro as well. Yes, so the Governing Council defined price stability as inflation of below but close to 2% over the midterm. That's what their target. This is the target given. Price stability is essential for promoting economic growth and job creation, which are co-objectives of the European Union. So that's why they need to maintain the price stability with this ultimate objectives, right? So that ECB has the monopoly on the issuing of banknote, so that the banknote, or that they have common money, so the euro, so that ECB is the issuing authority. It influences the amount of money in the market by controlling money available to eligible central and commercial banks in the member states. So because they are having 19 member countries there, so that they have to ensure the overall money supply in the whole area, right? They have to control the money available, right? All the commercial banks, that, and also all the central banks, and also the commercial banks in the member states. So that European Central Bank, they makes weekly announcements on the amount of money it plans to supply and the minimum acceptable interest rate, so that they have to announce it weekly basis. Eligible banks that have provided collateral, right, then place their bids for the European Central Bank funds through an auction mechanism, right? So once the banks have obtained fund, they use them to advance loan to individual and businesses. So like that is the mechanism that the European Central Bank used to supply money into the system. So every week that they are announcing what is the level of money that they plan to have in the system with the acceptable interest rate. So the banks or the players that they can bid uh, with the interest rates, right? That's how that through these auctions that money is coming to the system, right? So when the banks that they have obtained funds, what they are going to use, what they are going to use this money for, that they are going to lend them to the individuals and businesses. That's how that money is going into the system, right? So at the same time, other than the monetary policy, that they have to supervise the overall banking system as well, right? So that ECB is responsible for banking supervision in all the member states and carry out this function through the single supervisory mechanism. They have a very strong single supervisory mechanism that comprises of the ECB and competent national authorities in the member countries. That there are separate authorities in each member country to support that mechanism. So that it is worth to remember that not like the other countries, especially in Fed system that we saw, that each Fed reserve banks that they have the authority to supervise the commercial banks in their districts or the regions. But here there is a single supervisory mechanism to overlook the overall system in the area. But in each country, there is a separate national authority in all the states that, with the support of this the separate national authorities, that the ECB is conducting this supervision. The ECB has the power to grant and withdraw banking license, conduct supervisory reviews, and set higher capital requirements to counter financial risk. So, by the system that they have in ECB, that it is giving the license for the banks to do their business, and also the same way that they can cancel the license as well, that in case that the banks are not going to perform in a way that required, and conduct supervisory reviews and set higher capital requirement. And why to set higher capital requirement, right? Why? To mitigate the financial risks, right? At the time that we discuss about the compulsory or the statutory requirements that I mentioned you, that it is a prudential measure to safeguard the system. Because why? That in case that there is any issue, solvency issue, that in case that the bank has has a higher reserves with the central bank, that it can be survived, that central bank also can support it to be survived like that. The same way here also, that if there is any risk that they can predict, no, in case that there is a higher risk, that they can set higher capital requirement. So only the banks who has that capacity only is going to be continue with their business. If they don't have to absorb such a risk, means that they have no enough adequate capital or the resources, so that they have to leave the business. That's how that mechanism is important for them to maintain the stability in the financial system. The ECB directly supervises 124 significant banks that hold 82% of the banking assets in the euro area. That's why at the beginning I said that ECB is really important, because why? Now see the capacity that they have. They are directly supervising that very significant banks, the big banks in the euro area. So that their in overall their size is more than the 82% of the banking assets in the area. So that their single supervisory mechanism should be very powerful. So that's why this ECB is really a specific kind of a bank. Other responsibilities include conducting foreign exchange operations, promoting the proper functioning and safety of payment system, and managing the Eurozone's foreign currency reserves. So these are more similar to the functions of the Central Bank of Sri Lanka as well. So you can see that foreign exchange operations that it is there. So that's how that foreign currency reserves are also maintained in the ECB for the area or that Eurozone. And the payment system, they are having a very common, that they, for all the states, that they are having a common payment system. So that system is also regulated by the ECB. Okay, so what about the monetary policy of the European Central Bank? That European Central Bank uses interest rate as major monetary policy tool. I think better you remember that interest rate is used as the major monetary policy tool. In addition to setting key interest rates, CEB conduct open market operations as well. Right? So the governing council of the CEB sets 3 key interest rates. Right? There are 3 key interest rates are there. But with respect to the Fed, that we saw that there is a one interest rate, that discount rate, right? So, and also they also conduct open market operations. But here that for the European central banks, that the major monetary policy tool is the interest rates, that they are giving more emphasis on this interest rate rather than conducting open market operations. The first one is the interest rate on the main refinance operations. In these operations, bank can borrow liquidity from the euro system against collateral on weekly basis at predetermined interest rates. I hope that you remember that there are 3 types of interest rate that we also at the time that we discuss about the monetary policy tools of the Central Bank of Sri Lanka also we discuss about different type of interest rates. So you go back to the lesson and revise it, that you can see the same type of different interest rates are they are determined by the Central Bank of Sri Lanka as well. But that here that the facility is given for the banks, right? Actually that it is actually the financing facility, right? So remember that at the time that we discussed about the operations of the Central Bank of Sri Lanka, that stand lending facility rate that we discussed, right? There is a predetermined interest rate is there, right? That for the deposits and lending, there are 2 rates that predetermined by the Central Bank of Sri Lanka, and these 2 rates are work as a corridor to give signals to adjust the overnight call money market rates as well. I hope that you remember that time we discussed in detail how it's working. Right, the same way here by the ECB also, that they predetermine the rate, right? Main refinancing of there is a one particular rate for the main refinancing operations. Under the main refinancing operations, what they are doing, the banks, they are giving, they actually lend for the banks. The bank can borrow liquidity from the system, but again the collaterals, right? Against collateral. But the time period is here weekly basis, not like in Sri Lanka that it was overnight basis. It is overnight basis, but here it is on weekly basis at a predetermined interest rate. The rate on the deposit facility, which banks may use to make overnight deposits. See here the overnight deposits with the euro system at preset rate lower than the main refinancing operations rates, right? So it is obvious, right? Deposit rate is always lower than the lending rate, so that the rate for the deposit facility is lower than that. But the maturity is also different. That for the main refinancing operation that they are lending for the banks for the weekly basis, but the banks deposits on uh, overnight basis. The rate on marginal lending facility, which offers overnight credit to banks from the euro system at an interest rate above the main refinancing operation rate. So it is again a lending rate, but that lending rate is that maturity is very it is that the first thing for the weekly basis. Here it is overnight basis, right? But interest rate is above the main refinancing operation rate. Why? Because it is that the banks are required instant funds, that that overnight credit, right? So that you can understand that there are three different rates. Why these the rates are different, right? That is overnight credit to banks. Right. So that's why that there are three different rates now. Main refinancing operations, that that euro system, that they are giving funds to the banks on collateral basis for week period, the seven days period. It is also predetermined rate. These all three rates are predetermined rates. The rate on the deposit facility and the rate on the marginal lending facility define a corridor for the overnight interest rate at which bank lends to each other. The deposit facility rate acts as the floor of this corridor, and the marginal lending facility acts as the ceiling. The same way that in the open market operations also here in Sri Lanka also we can see that two different rates are predetermined by the central bank to work as a corridor, that lower bound and the upper bound has been set. So in between that market rates are fluctuating. So like the same way that ECB also using these policy interest rates. That three key interest rates are these three interest rates, right? So, and other than that, so these are the interest rates are actually their key monetary policy tools that they are using. So other than that, these are actually that at the time that we discuss about the monetary policy, I think I mentioned about that conventional monetary policies and unconventional monetary policies, that unconventional measures that many of the central banks around the world, that they have to practice those unconventional or understanded measures in a very specific scenarios where that their conventional monetary policies are not going to be effective because of that it is a special kind of a scenario that they have given. It can be either the financial crisis or the health crisis like that we are currently experiencing, COVID pandemic. So that suddenly that almost all the economy is hit, right, by those crises, and that many of the economic activities are going to be suspended. So in such scenario, that the responsibility of any central bank is to use any alternative method, the measures to boost the economy. So with respect to the European central banks, we can see especially there are some non-standard measures that they have been used. Since the financial crisis began in 2007, the CEB has introduced several non-standard monetary policy measures. The primary aim of the ECB's non-standard measures was to provide liquidity to banks and to keep financial market functioning. So because of that crisis, actually that many of the banks or the system had been dried out. So that's why that there should be kind of a mechanism to pump money, provide more liquidity into the system to make them reactivate. So that's how these non-standard measures came into play. In 2008, banks could no longer rely on borrowing from each other. So normally, in the normal circumstances, that we can expect that if there is a liquidity shortage in a one particular bank, there is a way that particular bank to go and borrow from another bank. But under this special situation, that there is no way that any bank to have to meet their liquidity requirements. So that CEB provides unlimited credit to banks at a fixed interest rate, right? So that now you can understand. But earlier, under the standard measures, they have that three interest rates, right? Three type of policy rates that they are using, right? For the lending also, that they are using two type of rates, but here that they have to provide credit unlimitedly to the banks at a fixed interest rate known as fixed rate full allotment. That it is a specific term that they use for that facility, that fixed rate full allotment. That what they did was that they provide credit to the banks at a fixed interest rate. The range of eligible assets that could be used as collateral in refinancing operations was expanded, right? At the same time, we saw that there is one particular main refinancing operation that under that facility, that banks, they have to use kind of collaterals when they are going to borrow money from the system, but that those collaterals are probably securities issued by the government, right? Likewise, but here that collateral that they can use in refinancing operations also expanded. Not only a particular security, but they are even going to accept corporate securities as well. So likewise, range of eligible assets also expanded. So these are that first one is fixed rate full allotment, and the second one is range of eligible assets. So these are two non-standard measures. Okay, going forward, let's see what are the others. In the second phase of the crisis, so that these two measures that they implemented in the first phase, but when it comes to more severe, they have to find out some more measures, right? In the second phase of the crisis, which okay, yes, yeah, back in the presentation. So in the second phase of this crisis, which took the form of sovereign debt crisis. So it is a sovereign debt crisis to address market malfunctionings and to reduce differences in. Excuse me, I can hear some disturbance noises. Can you please mute the mic? Someone is, yes. Can you please mute the mic? Actually, there is no way me to mute you from my side. Can you please mute the mic from your side? So, because there is a disturbance noise there. Okay, thank you. Okay, so in the second phase of the crisis, which took the form of a sovereign debt crisis, so it is go beyond that. So first it was in the banking sector, but going beyond that, it is going to be more so severe to address this market malfunctioning and to reduce differences in financing conditions faced by the businesses and households in different euro area countries. So they purchased debt securities, right? Carried out very long-term refinancing operation. It is called the security market program. That European Central Bank, they started to purchase debt securities. Uh, it is carried out very long-term refinancing operation for a long time, a period that they are going to purchase securities from the market. So it is another type of a measure that they use. In the third phase of the crisis, they address the one set of the credit crunch and the risk of deflation. So because of that, short-term interest rates already close to zero, so that there is a liquidity trap over there. So then it is really difficult, hard to get it rebounds, right? So intended to do influence the whole set of interest rate that are relevant for financing condition in the euro area. So these are the other measures that they introduce. So the negative interest rate on the deposit facility. So they are introduced negative interest rate to the deposit facility because it is almost near zero. So that's why they have to use to encourage to go for that. Targeted longer term refinancing operations designed to support bank lending to business and households. So that's how that ECB encourages bank to give loans to the households and businesses. And asset purchase program involving private and public sector securities to put downward pressure on the term structure of interest rates, right? So now the interest rates are more close to the zero, so that they started to purchase uh, private and public sector securities, right, at a lower rate, so that we can encourage people to see that in the future that interest rates are going to increase, like that we can change the mindset of the people by doing these measures, taking these measures, that that ECB try to uh, influence the people to be activated, right? Forward guidance, which means communicating how ECB expect its policy measures to involve in the future and what condition would warrant a change in the policy stance. So that always that they communicate with the people to give some good sign of the future, because otherwise all the people okay, so these are actually the alternative measures taken by the European Central Bank at the crisis scenario. So you may have heard about this, the crisis that they undergone during that period. Many of the states or the countries in the area were adversely affected, and that's why they have to introduce these alternative measures. Okay, so okay, I think now the time is up, so I'm going to stop by here. So there are some uh, other few banks that we have to discuss about, but uh, so other banks that we no need to take that much of a long time, because that this Fed Reserve system, it is a very complex system, and the European Central Bank system is also a specific kind of a system, or the central bank. That's why we had to take long time to discuss about their operations. And the next session that we are going to discuss about the operations of the other central banks, where we no need to spend that much of a long time for each and every bank. And here I have to mention you one thing, that you must remember the organization structure of each bank, and also their key responsibilities, what are their key objectives, and when it is come to the monetary policy, that you have to remember what are the key monetary policy tools that they are using. And also you better remember the leading people in these each institutions. Okay, so this information may be useful for you to face the exam well. So thank you so much. So I'm going to over the session now. Thank you so much.